Should you invest in real estate or stocks? I get asked this question a lot, but the real question to ask is this: which investment will provide the best long-term investment returns, real estate or stocks? This video will let you know. Come check it out. Hi, I'm Lachlan Campbell, the founder of Mad Success. Investing for the long term is wise money management. But when you're learning to invest and have built an initial pool of savings, how do you know whether to invest in stocks, bonds, real estate, private equity, or maybe even a startup business? There are many investment options for your savings. This video is for new investors and those interested to learn more. I will walk you through the pros and cons of an initial investment in real estate versus that of an investment in the stock market. And I'll talk about the potential returns of such investments with a straightforward example. Better money management means developing healthy money habits, growing a positive relationship with money, and learning how to save and protect yourself by investing wisely and not speculating with your money unless you can afford to lose it. Here at Mad Success, our mission is to empower you to design a life that you want to be living in alignment with your values and dreams, that excites you, that motivates you, that drives you. I want you to be living your dream life without the constant worry of not having enough money. But that requires you to have a plan for your life, combined with a plan on how you're going to finance your life. Remember, money is a resource, like time, your emotions, and personal discipline are resources that you use in support of and to live an outstanding life. If your life is currently less than outstanding, perhaps you could benefit from some professional coaching. If that's of interest, please send us an email at ask@madsuccess.com. Learning to invest wisely is a key part of supporting your life plan. Investing is about finding quality assets that will give you a solid long-term return on your money. Ideally, both in terms of capital growth, meaning the money is invested is going to grow, and in terms of income, meaning you will ideally earn some income from your investments, such as what you can do with both real estate and stock investments. But before I jump into that, I want to make a quick point about the timing of your money need as regards the question about whether you should invest in real estate or stocks. This video is going to assume you have enough of a lump sum of money saved and available now to invest either as a down payment on your first home or into the stock market. Why does this matter? Because if you don't yet have enough money for a down payment on a first home that you can afford, but you want to buy that home, say within the next 6 to 36 months, putting your down payment at risk by investing it in the stock market could delay your home purchase by months or even years. If the current stock market decline becomes a multi-year period of decline and creates stressful price volatility, you're better off investing your money for your down payment in an interest-bearing financial instrument like a short-dated government bond, a certificate of deposit, or putting your money into a high-interest savings account if that exists where you live, even if the money has to be locked in for 6 to 12 months. At least your down payment money is not exposed to the price volatility of the stock market over the short term as you continue to save for your first home. With that in mind, over the long term, building diversification into your investment portfolio is key, meaning you will eventually own both real estate and stock market investments in your portfolio. But as a new investor, you want to understand which of these two types of investments will provide you with the best long-term returns and why. So which of these two asset classes, real estate or stocks, has produced the best long-term returns? What you're really asking is, if I buy a house, is it a better place to put my money than to buy stocks? And that's a very challenging question to answer because we're not comparing apples with apples. And where is the house located and what stocks are you buying? Is the house located in a high-growth urban area or out in a remote countryside far from typical urban real estate investor demand? There's likely a substantial investment return difference purchasing a 2 to 3 bedroom apartment in the downtown core of a large city like Chicago or London, England, versus buying a 2 to 3 bedroom home far out in the country in a place like Billings, Montana in the US or Doncaster in the UK. Are you buying single stocks like Apple or JP Morgan, or mutual funds and exchange traded funds? It's one thing to compare investment returns of, say, the S&P 500 stock index as a whole over a 30-year period with an institutional real estate fund, and that can be done pretty easily. But comparing the returns of individual homeowner purchases versus that of single stocks or a broad stock index return doesn't really give us information that's reliable. The S&P 500 index has a long-term average historical price gain of around 10%. Home ownership in the US, for example, has long-term average price gains of around 6%. But that's an average across the whole country. And as I just mentioned, where you buy your home makes a huge difference on the expected investment returns. Both of these historic price figures, 10% and 6%, are before the impact of inflation, meaning these are what are called nominal returns. At today's rate of inflation, which is around 8%, investing in a home wouldn't seem to make sense on the surface purely from these statistics because, for example, a 6% return in real estate is less than the current inflation at 8%. So the real return is an average negative annual rate of 2%. In general, though, stocks do tend to rise in value faster than real estate when prices are rising, but stocks also fall a lot faster when prices are in decline, which means stocks experience significantly more price volatility and many more pronounced global boom-bust cycles as compared to real estate, as we're seeing in today's market with corrections in stocks of 30, 40, 50%, and by as much as 90% in the case of some of the once high-flying meme stocks like Peloton. Home prices can rise and fall over time, that's for sure, but they tend to be a lot more stable than stock prices, even in times of economic crisis. The global financial crisis, for example, in 2008-2009, saw home prices in many markets fall significantly and quickly, especially in the more speculative, overbought markets like Las Vegas, Florida, and California. Yet stocks also crashed hard. And those stocks tend to recover more quickly. They also typically have more periods of significant price volatility year to year as compared to real estate. So the sleep at night factor is more regularly stressed with stocks than with real estate. An investment in a home for you to live in must also consider the overall benefits of the home to your lifestyle, not just the investment return, including comfort, convenience, building a family, a sense of security and community, and the like, which an investment in stocks simply cannot give you. We also typically buy our homes with leverage, meaning we borrow money to buy the home with a home loan or mortgage on top of our down payment. So we get a lot more value for the down payment we invest. But a mortgage is debt, and you should only take on an amount of debt that you can afford so that your monthly loan payments are not causing you financial stress and you're still able to live your life comfortably and continue to save money for your other life goals and objectives. With stocks, we typically don't borrow money to invest. We buy $100 of stock with $100 of savings, but we could borrow to invest. But this is a lot more risky given stock price volatility, and the loans are much shorter term and more expensive. And you're either paying for the loan from your income if you borrow from a bank, or out of your investment account savings if you borrow from your broker, which is known as margin. Such borrowing, especially in volatile markets like today, could add significant financial stress if you're not careful. Investing in real estate with a mortgage is commonplace, and this leverage can provide us with significantly enhanced returns without adding a lot of additional risk. As well, the effect of mortgage leverage means that small returns on your down payment are potentially greatly amplified as a long-term investment. I believe the greatest risk in buying a home is losing your job and not being able to pay the mortgage, as is what's happened to many millions of people during the pandemic. But you also face that risk if you're paying rent as a tenant. But that's why you have a 6-month emergency fund, right? And if you're a freelance worker, you have a 6-month gig gap cushion, or what I call your living fund or must-have money. As a tenant, you have flexibility to move if the rent is no longer affordable. But as a homeowner, since your home cannot be sold quickly, especially in times of crisis, it's known as an illiquid investment, unless of course you offer to sell it at a much discounted price, which is never fun or a wise thing to do. As well, if you can't pay your mortgage and you default on it, which means you've stopped paying it, you risk losing your original investment down payment, which can be a costly mistake. Stocks, on the other hand, can be sold in an instant through your online brokerage, so that's a factor to consider. But the problem with the ease of which you can sell stocks means that inexperienced investors tend to panic when markets crash and they sell their stock holdings during the crash, whereas with a home, you're much less likely to panic and sell your home in a real estate crash. Firstly, because the home can't be instantly sold like a stock, but more practically, because you live in it. So, as a long-term investment, your home is more stable, and you're more likely to keep it long-term to benefit from long-term price appreciation. Rising interest rates impact real estate prices by making mortgages more expensive. Interest rates typically rise in periods of rising inflation when the economy is strong, like what is happening today, though it looks like we're at risk of a recession. Inflation is good for existing homeowners because rising home prices mean the value of the homes are also rising. But inflation is bad for new buyers as prices are rising, and in many cities around the world, home prices have risen out of reach for young and new buyers. If interest rates rise too fast, this can stall a rising real estate price environment and even lead to a decline in home prices, especially if mortgage costs become unaffordable. Fortunately, interest rates in most countries globally have been very low for the past decade following the global financial crisis, and home ownership was made possible for many. Let's look at an example to gain a better understanding of real estate versus stock investing. Sarah decides to buy a $200,000 home. She borrowed 90% of the home price, or $180,000 for 30 years at 3.5%. Her down payment was $20,000 or 10% of the purchase price. Jumping to the future, her home appreciated on average 6% per year over the 30 years that she lived in it and enjoyed the use of the property with her family. I've estimated that Sarah's original home price of $200,000 would be worth about $1,150,000 in 30 years, which is about a 5.5 times return on the purchase price. But Sarah only invested $20,000 as a down payment, and now the mortgage is paid off in 30 years and the investment is worth $1.15 million, which is an extraordinary return on a $20,000 investment. Taking into account 30 years of interest on the loan at 3.5%, which is approximately $110,000, the net value to Sarah would be something around $1,039,000 for a fully paid off home. Sarah has made nearly 52 times her original $20,000 investment over 30 years. By comparison, Kyle bought and held $20,000 in company shares over the same 30 years and received an average investment return of 10% per year, similar to that of the long-term return of the S&P 500 index, and 4% more than Sarah's average return. The final estimated value of Kyle's shareholding would be around $350,000, or about 17.5 times return on his money, over that same 30 years. Not bad, but nowhere near as much as Sarah's return. The Kyle example does not include any stock dividends, which is a possible source of income from share investing and could have positively influenced Kyle's overall investment return, especially if the dividends were reinvested, which is the effect called compounding. But on a like-for-like basis, the real estate investment had a much greater potential return because of the effect of mortgage leverage. For Sarah, as a real estate investor, there are many home ownership costs that would have eroded her total return, such as insurance, utility costs, plumbing, painting, and other repair costs and maintenance costs, etc. But they are unlikely to be so substantial as to make a material difference in the return on investment that she earned over Kyle's stock investment. Investing in real estate is also a great way to create cash flow from rental income, much like how Kyle could have earned dividend income from his share investments. If Sarah decided to rent out a room in her property, she could have made her returns even greater. This is known as house hacking, where you use rental income in your home to offset and reduce the cost of your mortgage, or in some cases, you can end up living for free. If the rental income is more than the mortgage payment, as well as home maintenance costs and homeowner insurance, then you're living for free. This is a key reason why many people buy real estate for the long term, to create a portfolio of properties that can provide significant income into retirement, or at least to pay off the mortgage, as in the case with house hacking as mentioned. Investment income from dividends and rent are at the heart of becoming financially stable and ultimately financially free. When your investment portfolio grows large enough for your after-tax investment income to cover all of your ongoing monthly expenses, you are financially free, meaning technically you no longer have to work. Instead, you have the choice to work because your passive income from your investments covers all of your expenses. Home ownership also offers certain tax benefits in some countries, where mortgage interest payments and depreciation deductions of the original purchase price of the property can be used to lower your income taxes. But please check with a tax advisor or tax accountant in your country to learn what's possible. Investing in stocks, mutual funds, and ETFs can be tax efficient if you invest through a government-sanctioned tax vehicle in your country, where capital gains and dividend income can accumulate tax-free, such as with RRSPs in Canada, 401k plans in the US, and IRAs in the UK. Some of these government programs also allow you to invest in real estate, so please check what's possible in your country. Whether you're investing in real estate or stocks, it's important to do your homework. In financial markets, doing your research and understanding the potential investment is known as due diligence. Due diligence is the process of understanding and mitigating risks associated with the investment. As well, in the case of real estate investing, due diligence is the process to assess and appraise the value of the real estate so that you can make an informed offer decision as the buyer. Researching real estate markets, searching for a home, and completing all of the purchase paperwork, including obtaining approval for a mortgage, takes a lot of work. Maintaining the home also takes a lot of time and work, even if your real estate purchase is for investment purposes and you hire a property manager. There are still decisions that have to be made, costs incurred, etc., on an ongoing basis as part of real estate ownership. With stock market investment, if you're not inclined to follow the markets or follow economics and research companies, then please hire a financial advisor or put your money to work in a diversified selection of broad index investment funds, or invest through a robo-advisor where the investing is done for you. But please know this, it's important, my friend, to have some understanding of the languages of money. Accounting, economics, and investing, so that you can grow and learn and become empowered as an investor. And that takes time and effort. Empower your financial future and become a confident investor. And starting here with Mad Success videos is a great place to begin. So I acknowledge you for making these efforts and thank you for your support. As we saw in the global financial crisis and in the current stock market crash, investments do go down in value. And the crisis aside, not all real estate investments have a positive ending. Entire communities can collapse because a nearby factory shuts down, or the town is devastated by a tornado, a hurricane, or a flood, and it can take many, many years for house prices in the community to bounce back, thereby radically altering the potential investment returns for the worse. Doing your research and understanding the risks are an important part of real estate investing and investing in general. The long-term benefits of real estate investing by use of mortgage to leverage the returns is very attractive. And when you consider the positive factors of owning a home and not having to pay rent while earning potential long-term profits on the home, including some possible income, it's a compelling case to consider. And we all need somewhere to live. Real estate investing is also fun. I do a lot of it. There's an emotional charge to buying your first home or investment property. You can touch it, you can walk around the neighborhood, you can enjoy the investment personally and share its benefits with your friends and family in a way that's not possible to do with other forms of investment, such as with stocks. But all investing has its risks, and home ownership has plenty, including factors often out of our control like termites, floods, fire, earthquakes, and crime. Fortunately, the impact of these factors can be taken care of financially with insurance, though the emotional and psychological impacts often take a lot longer to contend with. Bear that in mind. Investing in the stock market is a necessary part of long-term diversified investment planning and in support of your life dreams and desired outcomes. And investing in a home could prove to be a wise investment with the right opportunity. So, returning to our original question, which investment will provide the best long-term investment returns, real estate or stocks? Bottom line, according to Forbes, real estate has created more billionaires over time than any other asset class. And according to a study assessing asset price returns over more than 100 years, from 1870 to 2015, published by the Federal Reserve Bank of San Fran in December 2017, real estate investments outperform equity investments over the long term, and with less volatility and greater income yields. So whether the timing is right for you to buy your first home or to invest for the long term in stocks, it's really up to you. But building a diversified portfolio is key. And remember, both require research and due diligence to ensure you're making a wise investment for the long term. But real estate has the historic edge. Empower your life and your financial future. As a professional life success coach and a money coach, if you're stuck in some area of your life or you're looking to incorporate a holistic financial well-being program in your company, send me an email to ask@madsuccess.com, or please feel free to ask any questions in the comments below. If you got value from this video, please hit that like button, subscribe to the Mad Success channel, and please share it with family, friends, and colleagues who could benefit from it. Thank you for listening. I'm Lachlan Campbell, and this is Mad Success. Cheers.